Good afternoon, everybody. Leonel, Ceballos, Realty Executives here today with Phil Latuan from Exchange Resources. How you doing, Phil?
Doing great. It's good to be with you.
Good to be with
Thanks,
you,
Leonel.
buddy. Thank you so much. Thanks so much for taking time out of your busy schedule. I know that you represent not only this company, but you represent, I think, you're director of the Escrow Association in Southern California.
Yeah, I'm on the board of directors there. Yeah.
There you go. So that's certainly, I'm sure, keeps you really busy.
It does.
Awesome. So today the purpose is actually to educate, our community and even our real estate professionals to let them know what a real 1031 exchange really is, what it entails. You and I have had a few, and we're looking to do a lot more. So why don't you let everybody know who you are and a little more about you, and we can get started with what a 1031 exchange is.
Thanks, Leonel. Hi, everyone. I'm Phil with Exchange Resources, and yes, I'm a resident of Whittier, and we've lived there for over 31 years now. I've been in the business since 1982, and ultimately I have a pretty decent idea as to how a real estate transaction happens. I've been in the actual 1031 exchange portion of that business nearly 22 years now. And basically, a 1031 exchange is when an investor is selling a rental property, a property that they own for investment, like a multiple unit apartment building, a condominium, a rental home, or a commercial building, any kind of investment property that they hold for their business or investment use, and they don't want to pay the capital gains taxes when they sell it. The reason why they want to sell is because they want to re-leverage the equity that's grown over all those years to be able to buy additional properties or larger properties that ultimately are going to increase the owner's cash flow, appreciation, and tax write-offs. We need all three as investors because together they create the right product for us. And diversification is the best way to go. The exchange allows you to defer the capital gains tax when you sell it, so you don't have to pay the federal government and the state government. Average person is going to average somewhere between 28 to 45% in taxes. And they get to keep all that for the acquisition of the new replacement property that will be better for them.
That is awesome. So you and I have done a few, and I know that one of the things is most people don't know there's different ways to do an exchange. So let's talk about what is a regular 1031 deferred exchange.
A 1031 exchange is when Leonel lists your property. He's going to put special language in your sales contract that says you're going to be doing a 1031 exchange. The reason why he does that, it allows a company like mine to set up the exchange while it's in escrow. It has to be done while it's in escrow. After the sale closes, you can close your purchase either on a concurrent or simultaneous basis, which most people don't do. It's very difficult. Or they can close their acquisition up to 180 days later, which is about this much less than 6 months. So you have 180 days to close a purchase, with the first 45 days to designate what you're going to buy. So the government has you on a tight leash for the first 45 days, but you can help them find that property even before the sale closes.
That's right.
So you don't have to panic during those 45 days.
So that leads me into the next question, and which, let's say we're in a 1031 exchange, but we cannot find a replacement property, which you and I have run into some tight spots sometimes, but we managed to finally identify properties and close. What other way can we do it so that we don't have that time constraint?
The best way I have found is when you put that information in their sales contract, to put contingency language that gives you either a 30-day extension to the close or a 230-day extensions to the close if necessary to get into escrow on a new replacement property and then release the contingency so you can go ahead and close on your new purchase, so you don't have to fret or sweat those 45 days of identification.
So to clarify, so basically let's say I identify a property and we enter a 45-day escrow. So what Phil is referring to, that in the contract or in a counter offer, that I can ask for an extension automatically, the 30 or a 60-day extension, giving me an option that if in the first 45 days I don't actually identify a property, that we have 1 or 2 additional extensions automatic on the contract that would allow us to obviously not risk not following the rules of a 1031 exchange. Am I correct?
Exactly, you're exactly right, because you can't extend the 45 days, but you can prevent them from beginning by getting those extensions.
And so what that means is basically I enter the escrow, and as long as the escrow doesn't close, it gives me more time to identify the property, which is the 45 days. And if I can identify it prior to closing the escrow, the better it is for us, right?
Exactly, and I want to comment on that.
Okay,
Leonel, let's say I'm selling a condominium.
sure.
It's a rental.
Right.
I've had it rented for a number of years.
Right.
I can go into literally any kind of investment property. I can go into a fourplex. I can go into a commercial building.
There you go.
I can go into a little shopping center or an office space.
Right.
I could even buy a building to put my business in and operate my business under. The government says it could be any kind of investment real estate or business use property as long as I acquire for equal or more than what I sold for. So for example, if I sold for $1 million,
Okay.
I need to go out and buy for roughly $1 million or more and reinvest all the cash. But if I want to buy 2 buildings, I can buy 2 of them, one for 600, one for 400.
Right.
As long as I hit that $1 million acquisition price, because they sold for $1 million, the government will honor that. I can distribute the cash. I can re-leverage a little bit. It's a good thing for me and my investments to do so, and that's why people do 1031 exchanges.
So if I understood you correctly, basically, if I am netting $1 million, if I have $1 million to reinvest, but I am able to buy, let's say, a property for $600,000 and another property for $500,000, that puts me above the $1 million. That would be legal to do, to acquire 2 properties?
Absolutely. The government will allow you to do so. And you know what that's called? Diversification. So instead of just appreciating with one property, now you have multiple properties to appreciate with. Now you have more doors that are going to pay you rent. Very simple. If you want to get a paycheck, which is a rent check, once a month, you own 1 unit.
You own 1 unit.
But if you want to get paid every week, you have 4 front doors that are going to pay you. But if you want to get paid every day, you need 30 front doors.
You need 30 front doors.
And you get to choose how many front doors pay you rent. And it's simply by re-leveraging the equity to create more property that will appreciate, instant cash flow, because the bottom line is rents are not going down, my friend.
Not at all.
Rents are going up. Even with all the talk of rent control, they're going up every single year. And the bottom line is you always have a built-in hedge to inflation.
That's absolutely right. I want to segue into the properties. So you and I did a deal, I think it was 4 years ago, where we sold 2 properties. I think one was in Big Bear, the other one was in Riverside, and we bought 4 properties with that as a result of that. I know one of the units now, we bought it at 630, is a duplex in Riverside. It's a great property, and now it's worth about $1.1 million. So what should I do with that now? Like, we're ready to go to the next step. What is that? What do you recommend us that we do now?
This is what I recommend. That's a good question. The key to any 1031 exchange is not what you sell, it's what you buy.
There you go.
So the first thing that I would do is that if you're my agent and I'm sitting with you asking you this question,
Right.
I'd say, Leonel, what can I go into that will help me to continue to grow through the days and years ahead?
Perfect.
In terms of more doors that will pay me rent, the ability to appreciate better,
Right.
and something then when I buy up to create additional tax write-offs for me so I can keep more of what the government is trying to take.
Perfect. So on that segue for this particular property is a house which has 5 bedroom, 3 bath, and that's the back house, and then it has over 3,500 square feet. Then a front house with 2 bedroom, 1 bath that has about 900 to 1,000 square feet. And so what we're going to do is move that equity and relocate it into a 4 or a 6 unit. That's the next step. So 4 years it took us to buy this property. Now we're going to basically put the property into a 4 unit to have more dollars to your example. One of the things that I'm running into, Phil, is that I see a lot of homeowners that buy their property either in the 40s, 50s or 60s, and this is their single family residence. And so what happens is now they're renting the property, and I look in the tax records and they had this property paid off for the last 20, 30, 40, and believe it or not, 50 years plus. And basically there is, what advantage do they have now? I mean, they haven't re-leveraged that equity, and yet they have, as far as I understand, no benefits of owning that particular property from the perspective of having tax advantages. Is that correct?
Yes, but let me speak specifically. Now, is this a rental or a personal residence?
It's a rental. So initially they bought it as a personal residence, and now they either move out of state. So these are all out of state owners in your city, here in Southern California. Now they live out of state and they rent the property, and they've been renting it, like I said, 20, 30, 40, 50 years. And so they haven't done an exchange, or they haven't utilized this particular service.
Right.
What is the first thing that they should do?
Well, here's the benefit, first of all. Some investors want their properties closer to where they live, because it's very difficult to manage properties that are, 2 or 3 hours away via airplane.
Right.
So that makes it difficult, and the beauty of the exchange, it allows them to buy something that's a little closer to where they are. They can keep an eye on it.
Sure.
Other investors who have owned it and who might live here, see what happens is that, let's say we have 2 properties. Let's say we have property A, property B. Let's say we bought them both in the same year.
Mm-hmm.
They're the same floor plan. They're the same square footage. Everything's the same except this one's paid off and this one is not.
Okay.
Well, here's the question. Which property would actually give me a higher rate of return based on the equity that is in the property? The first one that's fully paid off, or the second one that is not? The answer is the second one. See,
That's funny.
This
Okay.
is a funny thing that people don't understand. Because I have more equity in the property, it doesn't mean I can charge more rent on this one over this one,
Right.
because I have less.
Correct.
Your actual rate of return per dollar of equity is higher on the non-leveraged than the leveraged. You're always better off having a little bit of leverage on your rental properties because the rate of return is higher. Number 2, which one will appreciate faster? The one that's paid off or the one that's not?
The one that's not.
They're both going to appreciate at the same rate, if you think about it.
Right.
Because it has nothing to do with
That's
equity.
the value, yeah. Okay,
So far the rate of return is higher on the leverage one.
You're right.
It's higher, it's the same in terms of appreciation. And then the third thing is, which one is going to give you better write-offs? Well, they're both going to depreciate at the same rate because they were purchased at the same time, same year. But the difference is I've got interest to write off on this one, whereas I don't on this one. Some people say, well, the new Tax Relief Act that Congress passed a couple of years only has a limit of $750,000. You can't write off any more interest. But folks, that's not true. You've misunderstood it. See, it's only true for your principal residence and your vacation home. It is not true of your rental properties. Therefore, you can leverage pretty high on your investment properties and still write off all the interest, where you can't do that with your home. And that's a beauty. The beauty of leveraging your property not for the purpose of just draining equity, but putting the equity to work harder for you so you'll get a better rate of return on your investment dollar in your properties.
So that's wonderful information. I hope that everybody really got that particular part, because obviously with the new tax reform, there is some changes that happen, and obviously the best person, we're not tax advisors, the best person to go to would be your tax person, your CPA, somebody that helps you out with that. But there's something that I definitely want to talk about. How long can somebody depreciate a property?
It depends. When you first acquire the property, let's say it's a brand new purchase.
Brand new purchase.
If it's residential means single family, condo, 2-unit to 110,000 unit. As long as it's residential,
As long as it's residential.
it can be depreciated for 27 and a half years.
Let me repeat that to clarify that part, because from a perspective of as a real estate professional, we always look as residential being 1 to 4 from the purpose of financing. But in this case, it qualifies as long as it's actually a home or a condo or apartment is considered residential. So it doesn't have a limit, or is it just 100 up to 110?
It's whatever you want it to be, because for financing purposes to the bank, they charge you a different type of interest and loan rate for 5 units and above. But the federal government still recognizes a 200-unit apartment building as a residential building because people live there.
Right.
So you can write that off for 27 years.
27
and a half, technically.
27 and a half. So folks, for 27 and a half years, you can ride this particular property. That was my point on saying that a lot of people have their property paid off, and frankly, that you're not writing anything off because you have it paid off.
But more importantly, it doesn't mean not that you don't have a write-off, but the government's taking a higher percentage of your rent because you don't have that write-off anymore. And the government, let me tell you something. Taxes are not going down, folks. They're just not, especially in California. They're going up. You need as much of a write-off as you can get because the more you make, the more they take.
So want to make a second distinction. So this is on homes, this is on condos. Now there is a second part that applies if they bought businesses or commercial, which is for how long can depreciate a business or
Well, the business use property, so it's any kind of commercial building can be depreciated for 39 years.
Okay.
Now a lot of people say, well, 39 years sounds a lot better. But it's based on the same amount of acquisition value of the capital improvement. So the bottom line is you actually get a higher amount of depreciation per year and get to take it faster on the 27 and a half than you do the 39 because they reduce the amount of depreciation that you can take even on the same valued asset. So in my humble opinion, I like residential a lot.
So I think what Phil is referring to, let's use $1 million for example. If you have a residential property that you're going to use depreciation, is basically 27 and a half years, and those are the years that they break it down to. And if you have a commercial property, basically it's 39 years, so you have a lot more time. The same million is going to depreciate a lot less, meaning the amount of depreciation is going to be less. So that's a little technicality that you're welcome to call Phil or ask your tax professional that they can basically give you the green light on that. This is such a passion for me to talk about this particular subject because is an unknown, if you will, out in the marketplace. As much as there is property right now, like I have software where I can look at any city, and there's so many properties that are paid off that one, that they don't have a living trust, so in the risk of probate. And second, they basically paid off, so they don't have the write-offs and they don't have the benefits. And here's an opportunity for you. Irrespective of the age factor that you may have, this particular transaction that we did 4 years ago, my client, she was 78 and he was, I think, 83 at the time. So they had 6 properties paid off. And that gives us an opportunity. We walked in, we presented this situation, and they had no idea. They had no idea that they could do this. Now they have 4 properties, out of 2 they have 4, and their net worth went from, I think, $850,000 to about $1.5 million. And that equity now has grown to about another $500,000 easily in a 4-year period of time.
What does that tell you? Releveraging is the key. You don't even have to sell to releverage. You could refinance it, take money out, and buy a property. There's 2 different ways of doing it.
So why don't you tell them about that? Because I usually have, I'm about to, everybody that basically they got a property in the last 10 years, especially if they got an investment in the last year when the market was down from 2009 to about 2017, they got a really good price. And so it's time now to re-leverage that equity. So why don't you tell them the second part of that? When you said that they can pull money out.
Yeah, there's an option. I mean, if they're really emotionally attached to the building or it's really in a prime area or something of that nature,
Okay.
they can just refinance and take whatever amount of equity they want to acquire another building without having to sell that. There's no need for a 1031 exchange, so you won't need me. But if that's what you really want to do with that particular property, then it might be the right move for you.
So on that side, thank you for that. And I want to talk about how important it is for people to have a living trust on their property.
I can't emphasize that enough. Let me explain. When you pass away, your property goes into probate.
Right.
It would have cost you $2,500, maybe $3,000 to pay an attorney to do a trust. When you go into probate, you're going to pay hundreds of dollars per hour for days, weeks, or even months to probate the property. You won't do it because you're dead, but your heirs will. You can pass so much property without having to go through this expense and time of probate by starting a living trust. And the beauty of a living trust is threefold. Number one, I avoid probate. My heirs get everything immediately.
Right.
Number two, the one thing I love about probate, my wife says, well, you're too much of a control freak. But you see, that's the beauty of being a control freak, that when I'm dead, everything that I listed out in the trust will happen. Those people will get what I want them to get when I want them to get it.
Right.
I like that because it gives me the control even when after I pass. Number three, if my properties are under the ownership of that trust, or if I own LLCs and my trust is the shareholder of those LLCs, all my heirs get a stepped up basis at the date of death. Now this is what that means. If I buy the property for $300,000 and then it's worth $2 million when I'm old and gray, and I die, under the trust, the value of the basis of what I paid for it is the same value at the date of my death. So if they receive it at $2 million and they sell it for $2 million, the government says there's no capital gain. You don't have to pay tax. Whereas the other way around, depending on how you have title, might put your heirs in that position. For $2,500 for crying out loud, or $3,000 or even $3,500, you can fix all three through a trust. I don't do trust. You need to speak to an estate planning attorney who specialize in trust, and they can help you and get your trust set up the way you want it and make sure all your properties are in it.
And so on that part, I'm glad he, without me asking him, went into a step-up basis. Because one of the biggest mistakes that people make is to inherit property during their life, and so that presents a different problem, tax problem for the homeowner and the heir, because the property is going to be reassessed, and the properties, there's all kinds of things that is going to happen. So that's why a living trust is something that I absolutely recommend. And part of the next segment, or the next time that we do this recording, is I'm going to have a state attorney be present. Hopefully you still come back so that the three of us can break it down for them and give them this information so that it will allow them. Trust me, like Phil said, let's say you spend even $5,000 on a trust. My understanding is that the living trust is going to cost you depending on how much you put in it. But I have different attorneys I work with that can help you out and put that together. But that is wonderful information, because the step-up basis is something that is really not talked about. Is really that I think probably my 8th year out of 22 years that I've been doing real estate is when I became aware of it. I had a hard time understanding it. I think I asked you questions, I asked a lot of questions, and I finally got to understand it. And now that is something that I truly believe on it. I think it's an amazing benefit for our community, for our society, for wealth preservation. And when you have your loved ones that you want to provide these properties and everything that you so hard work for, and so that they can adequately pay them. So what else? What are we missing so far? What else? So we gave them a lot of information in a very concise time, but I think we were very clear, and hopefully there's a lot more questions. What would you like to add?
Let me summarize. When you do a 1031 exchange, you need to acquire under the same ownership of equal or greater value.
You go.
This is what this means. That means all the cash from the sale needs to go into the acquisition through the third-party facilitator. That's what the government mandates. You can take out of the sale proceeds the commissions you have to pay.
Correct.
The escrow officer that's going to escrow your sale, the title company that's going to assure the sale for the buyer, the transfer taxes, the recording fees,
property inspection.
Non-recurring closing costs can come out. So if I sell for $1 million and it costs me $100,000 of non-recurring closing costs, as an example, I have to buy for at least $900,000 or greater. I reinvest all the equity, and if I paid off debt on this, I'll have to reborrow debt on this to get back up to the $900,000. So the government gives you this last great tax write-off. I just want to make a little note to this, and I hope you appreciate it.
No, I'm looking forward to it.
A couple of years ago, before the Tax Reform Act passed, myself and a number of people from our association flew to Washington, D.C. We walked the halls of Capitol Hill, met with a number of lawmakers. I've also met with the Speaker of the House back then to talk about the 1031 exchange. Why it's so important for the government to retain it, because what it does, it just doesn't help investors to expand the property, but it puts a lot of people to work. When all these people go to work, they get paid. When they get paid, they pay taxes. And then they go on, they spend money, and it's good for the economy. The government agrees with that. The exchange is truly a tax benefit where everybody wins. Everybody wins.
And so I think what you're trying to tell is that at some point they were trying to basically do away with 1031 for exchange.
They were considering.
They were considering.
I was on the table.
Okay, I actually read that when the tax reform was proposed, that one of the things they wanted to do away was the 1031 for exchange, and I'm glad.
I'm glad too.
Thank you for representing all
My
these
pleasure. I am
professionals.
very honored with our colleagues to do that.
Okay, perfect. So basically at this point, we're going to end this this for us is a blessing. I hope it is a blessing for you to utilize this information. We take the time out of our heart, really, because I really believe in this process that our community, all our society really need to understand what this is. And having Phil here to my right as professional that can literally, Phil calls you back, he meets with you. A lot of times he meets with my clients before I even meet with them, so that he can explain to them and they be clear, and then we go into the process.
The goal is to get, right before we began the filming, I called back a lady whose realtor referred her to me. I couldn't meet with them, but I emailed them some information, and we have a conference call scheduled for Monday morning. They're going to get everything they need, because my goal for the clients is to have all the information that they need so they can make an important decision based on their needs, not on mine. And that's what we want to do. We want to educate people so they can make great decisions.
One last question. I want to make sure that everybody understands there's a problem with access to exchange funds. Can I get part of those funds for me?
You can, but you'll pay taxes on that money. That's why the government wants you to reinvest all the cash into the acquisition. There's 4 basic taxes that are being paid. A lot of people think it's just the long-term capital gain, which is 15 to 20%. That's not the only tax. There's the state tax in California,
State tax.
as high as today, as high as 13.3%. Then you have the healthcare tax. Some people call it the Obamacare tax.
Obamacare.
After 200,000 of gain or 250, again, if you're married filing a joint return, you pay an additional 3.8 into the healthcare program. And then lastly, you pay the recapture depreciation tax. The government gave you all that depreciation. Now they're going to tax you 25% for selling the property, but you get to defer that also in the 1031 exchange. So it's an incredible vehicle for saving tax money and re-leveraging to buy better properties.
Thank you so much for bringing that point. I think we've said enough for today. We will record different sections. We'll meet up again. And while my intention next time is to build a case study, to actually bring a property and hopefully bring a client that will speak to this subject, how they got into the property, how they were able to utilize the 1031 exchange, and what the 1031 exchange has done for them. I thank you so much.
Yeah,
And,
it's been a pleasure and an honor, sir.
Thank you, sir.
You're welcome.